Have you been interested in investing in real estate? Well, if so, in today's video, I'm going to break down how you could do exactly this through the use of REITs, or real estate investment trusts. Today, I'm going to break down what a REIT is and how they've performed over the years, and the difference between investing in a REIT, which is similar to a stock, and private real estate. So let's get started. Hey everyone, Mark Rusin here, and welcome back for another video. If you're new to the channel, please consider subscribing and hit that bell to be notified anytime we drop new content. And for everyone watching today, please hit that like button, as it will be huge for the growth of our channel moving forward. As I mentioned in the introduction, today we will be discussing one of my favorite topics, REITs, or real estate investment trusts. For me personally, I invest roughly 20% of my portfolio in REITs. It's my way of gaining real estate exposure within the stock market. They work in similar ways to how you would think of a mutual fund. It's a real estate company that you can invest in that owns an array of different properties. These companies are structured similar to many of those that you invest in today, just as a corporation. But the unique thing is they are exempt from corporate income taxes, as long as they follow a specific set of rules. Those rules include investing 75% of their total assets in real estate. They must earn at least 75% of their gross income from real estate related activities such as property rents or mortgage interest or even real estate sales. But here's the catch, and this is one reason, and a primary reason, that a lot of folks like investing in REITs. They must pay 90% of their taxable income to shareholders in the form of dividends. Now, if you already invest in REITs, you realize that REIT dividend yields are usually higher than market averages. And this is one of the main primary reasons why REIT dividends are so high. It's due to the fact that they don't have to pay corporate income taxes, but because of that, they need to pay out 90% of their taxable income to shareholders in the form of dividends. They must also have a board of directors, a minimum of 100 shareholders, and 50% of the shares cannot be held by fewer than 6 individuals. Now, these rules are set up to protect shareholders. One of them being that the minimum requirement of shareholders isn't so anyone Joe Schmo can go start a REIT and just skip out on the corporate income taxes. It needs to be a legit thing. REITs are unique in the form that they can provide consistency to your portfolio, and they can provide income in the form of dividends, like we mentioned. A recent study by a financial company found that 83% of financial advisors recommend REITs to their clients. And that should tell you right there enough that REITs are a legit way to build stability around your portfolio. Now, I'm not saying go out and load up 50% of your portfolio with REITs, and I do love REITs, but again, I consistently stay around that 20 to 25% allocation over my total portfolio by investing in real estate investment trusts. Next, let's take a look at REIT by the numbers. REITs own $3.5 trillion of gross assets across the United States. 145 million Americans own at least one REIT or some sort of REIT investment within their portfolio, whether it's through their 401k, their taxable accounts, or their IRAs. REITs own over 500,000 properties across the United States. And there's 28 REITs that are included within the S&P 500. Speaking of dividends, that going back to that 90% of taxable income that these REITs have to pay out in the form of dividends, in 2019, REITs paid over $100 billion in dividend income. Now, turning our attention to performance, the REIT index has outperformed the S&P 500 15 out of the last 25 years. Over the past 2 decades, REITs have returned an average of 15% per year, outpacing any other asset class out there. Now, this was leading up to the pandemic, where REITs were brutally hit and continue to climb their way back. But again, since the March lows, REITs have been a strong performer in the market. Now, when you think of REITs, they're a great way to diversify your portfolio. You can go out and buy a company that owns hundreds and thousands of real estate out there. In fact, REITs own properties in 12 different sectors. Let's take a look at some of those. You can buy REITs that have retail exposure, Those could be your average strip mall. You could buy REITs that have hotel exposure or malls, apartment buildings, industrial, hospitals, office REITs, self-storage, which is one of my favorite sectors, data centers, which has been a strong sector within REITs, and even cell towers. Now, REITs are different than your normal stocks, like if you're looking at Apples and Googles and Johnson & Johnsons of the world. Because they are real estate companies, they need to be valued differently. So you don't want to focus on earnings per share and net income as much, because earnings are impacted by depreciation. And when you're a real estate company, you own a lot of assets which are depreciated over time. As such, instead of looking at valuations in terms of like a price to earnings ratio or a PEG ratio, you're going to look at things like FFO, or funds from operations. Another way to look at this is adjusted funds from operation, which could be thought of as looking at adjusted earnings per share for non-REIT stocks. Funds from operation is simply taking your net income and adding back any gains or losses from sales of real estate, and then also adjusting for depreciation, adding that back in. Other valuations to look at with REITs include NOI, which is simply your revenue minus your operating expenses, same-store NOI, EBITDA. When it comes to valuing REITs and simply trying to understand if the REIT is trading at a high valuation or a low valuation in terms of the stock price and the results, with non-REIT stocks, one of the most common metrics or valuation metrics to look at before investing in a stock is the price to earnings ratio, which is simply the stock price divided by the company's EPS. With REITs, as we just saw, EPS is not a thing that we look at commonly. We look at FFO. So simply you take your stock price for the REIT that it's trading at divided by FFO. You can also do this using the adjusted FFO. Same way you would do this with adjusted EPS. You would take your price divided by your AFFO. And from there you can compare it to a 5-year or 10-year average to kind of see where the stock is trading at based on that one valuation metric. Price to EBITDA, and looking at NOI growth and sales growth over the years is other things you want to take into consideration. Again, same-store sales, NOI is a key metric to look at with REITs as well. So you want to look through a different lens when looking at REITs. Do never compare REITs to stocks like Google or Johnson & Johnson. Never compare price to earnings ratios from REITs to non-REITs. With any dividend stock, you want to look at the payout ratio. For non-REIT stocks, you're going to look at what is the company's EPS compared to the dividend they're paying on a per share basis. Some folks look at free cash flow and get a payout ratio. With REITs, we're going to look at the FFO payout ratio. So you want to look at what's the company's FFO compared to the dividend that they're paying. Now you're going to see payout ratios that are going to be 70+%. Again, that goes back to what we talked about earlier in the fact that the company has to pay out at least 90% of taxable income in the form of dividends back to shareholders. Next, let's turn our attention to the difference between investing in REITs or private real estate. There's a lot of folks out there that go both ways with this investment strategy. There's some that just want to do the REIT because it's a lot easier. And I'm not going to sway you one way or the other, but I'm going to discuss and kind of go through the details on what I believe the differences are and what makes REITs such a good and solid investment choice. The fact of the matter is, when it comes to real estate, it's not if we should invest in real estate, it's how we should invest in real estate. And the two most common ways that you can invest in real estate is either through a REIT or through private real estate. Simply going out and buying a rental property or an industrial property on your own, or with a group of investors. If you've ever talked to anyone that has built some sort of wealth over time, a lot of them have one thing in common. They've invested in real estate over the years at least one point in time. And I don't believe real estate is getting any cheaper, and I don't foresee real estate getting any cheaper over the long term. As such, the real estate sector in itself is a great way to build wealth, and you can do that through REITs. REITs have been able to produce strong returns over the years. Like I mentioned earlier, they have outpaced the S&P 500 15 out of 25 years. And they've also returned 15% on average in terms of total return. That's taking the stock returns, the capital returns, plus your dividend each and every year. which has outpaced any other asset class. That in itself should tell you the power of REITs. Now, a couple of reasons that folks decide to side with REITs over private real estate is due to the fact that, one, I just mentioned how REITs produce strong returns, but they also have the ability to produce stronger and faster returns. If you've ever purchased a home in most regular real estate markets, you'll see you could probably count on an average of 6%. Now, right now we are in a housing boom, and I'm here in California where housing prices are increasing, it seems like 15% year over year each and every month, which now that's not realistic going forward, but over the long term, the housing market has increased around an average of 3 to 6% each and every year. But with REITs, what we saw was they have been returning 15% over the past 2 decades. Now, one of the common differences is when you invest in a REIT, you are investing in a company that owns thousands of properties. So right from the start, you're diversifying your portfolio. So if I go invest in a stock like Realty Income, they own over 3,000 properties. And now I compare that if I wanted to go buy a house in my local market, I own one house rather than pieces of 3,000 different properties, which is diversifying my portfolio. That is a check for REITs. Another reason I like to side with REITs is due to the fact that it is a much more liquid investment. Just like investing in a stock, you can simply, if you need the cash, sell the stock. If you have $100 invested in Apple and you need that $100, you can sell the stock and get your cash out. However, if I go and buy a rental property and I'm not planning on flipping it, even if you do flip it, you are invested most likely for at least a couple months as you rehab the property and get it up to par with where you want it to be in order to resell it for a higher price. So again, you have the opportunity for stronger and faster returns. You have a liquid investment, and REITs are a truly passive income investment. The company pays the dividends each and every year. You're invested through diversification over thousands of properties, and you never have to deal with nasty tenants. On the flip side, if you want to go to private real estate, you obviously have to have much more capital most of the time. Your capital is going to be locked up for long periods of time as well. Now, you could say you have much more consistent growth with real estate with 3 to 6% each and every year, but years like this, you're getting a nice pop. But private real estate also takes much more expertise. And when you invest in a REIT, you are paying essentially for that management team to be your experts or your boots on the ground. You're also paying for these REITs and their management team to handle those nasty tenants. With private real estate, you either need to take those phone calls when you have a water leak or something's not working at your property, or you need to pay a 10% fee to a property management team in addition to owning the property. However, when it comes to tax benefits, private real estate has a major advantage. You have the opportunity for tax write-offs. You could also do things like 1031 exchanges, which is a way for you to defer your gains on your real estate sales over the years. And with more recent tax updates, you have the opportunity for what they call opportunity funds, where you can simply get rid of the tax if you invest money into these certain sectors and hold them for longer periods of time. So either way, real estate is a key to have in your portfolio. Whether you want to put in the time, and maybe you do have the expertise for the real estate sector, or a group of investors that have the expertise, and that's great. If you're in it for the long term and you have the capital, private real estate might just be your answer. But for those of you that don't have the expertise or don't have the capital and you're just looking to add a little bit of real estate exposure, consider REITs. So just to recap, REITs are a great way to invest in the real estate market and gain real estate exposure. They've been around for over 60 years. And as long as they comply with a set of tax rules, they will not be taxed at the corporate level. It'll be pushed through to the investors. With a REIT investment, you're going to get, or you should get, higher dividend yields, consistent growth, and real estate exposure. And there you have it, a breakdown on real estate investment trusts. Now that you've had the opportunity to go through the entire video, hopefully you have a better understanding of what a REIT is and how it differs from non-REIT stocks, how you have to look at different valuations and different earnings metrics to evaluate whether a REIT is undervalued or overvalued. in the comments section down below. If you have any questions, please drop those down there, as I'll be happy to answer any questions. In addition, let me hear what kind of REITs you are currently investing in your portfolio. And I will also drop 5 of my REITs that are in my personal portfolio. With that being said, that's the conclusion of today's video, and I will see you next Wednesday. Take care.